Market volatility and pension losses. Okay, here we're going to be talking today about what happens when you have market volatility, what happens when your pension pot goes down, and what should you be doing. Okay, so for example, in 2022, we had extreme market volatility pretty much across all sectors of the economy. We're going to be diving into a detailed discussion today that I'm having with a client about their portfolio over the course of 2023. Lots of people watching think, oh my God, why are Cameron and James going to talk about one of their portfolios which are down? Even worse, why are they going to share it online? Because that's real life. Market volatility is real. Portfolios can go down. I've had some clients who've invested for 7 or 8 years. When you have a bad year, they suddenly seem surprised. And I'm like, yeah, but this is what happens. You have growth, and normally speaking, you have one dud year out of every 3, 4, 5 years. So just sharing my screen here. So what the client says, hi Dominic, hope you're well. I'm looking at the depressing status of my pension and wanted to check if there's anything that can be done to improve things. Any changes to this portfolio that can help the situation in any way at this point, as I've lost £77,000 from my pension. What is your current view about the Scottish mortgage future? So to put this into context, the client's pension is worth, it started just over £500,000. So the £77,000, whilst it's an extreme, it's alarming and a big sounding amount of money, as a percentage is around 16-17% of the portfolio, which over the course of 2022, when we've had extreme volatility in the market, is not necessarily that wild and is actually quite normal if you look at a client who is taking an equity risk of, I think there's a balanced adventurous portfolio. So you're looking at 65, 70, 75, 80% equity weighted portfolio, which is kind of the standard for the market. So I'm going to dive into my response to the client here in a little bit more detail. So I'm just going to change my thing, 1 second. So as we can see here, I said, hi, thanks for your email. Very well, thank you, blah, blah. I understand your concerns. As you've likely seen from most reputable sources, 2023 was an extremely volatile year. It will actually go down to the worst years equity markets on record. It narrowly averted being as bad as the 1930s in the final few months of the year. It's not necessarily specific only to you and your SIP portfolio. Clients globally looking at their portfolios returns across 2023 would have felt the volatility. No one can reliably predict the market and no level of portfolio diversification can protect from systemic risk like we saw in 2022. Unfortunately, anyone who claims they can reliably predict the market is either naive or often talking in hindsight. So what's really important here for clients to understand is if you're looking at your portfolio just over a 12-month period, this could very easily the other way around. And I have this happen all the time with clients. Say, Dominic, you're the best thing since sliced bread. I'm so glad I worked with Cameron James. My portfolio is up 17% over the course of the first 12 months. I can't wait to introduce you to all my friends. You're such a fantastic financial advisor. I love the credit, thank you very much, but it isn't necessarily about Cameron James being absolutely fantastic as why the portfolio has grown. We've just picked a good, diversified portfolio in good asset classes in line with your risk profile. Equally speaking with a client, when markets go down, it's not, oh my God, Cameron James are horrific at their job. No, the portfolio is actually fantastic. And if it hadn't been a dud year in 2022, the client would have performed very well. Now, unfortunately, when a client does begin a portfolio in the first year of investment, if you do have a bad year, it is unfortunate because obviously it affects your long-term market returns, but there is nothing that you can do about that. There is literally nothing you can do about that. You can't decide at what point you're going to decide to consolidate your pensions. For a lot of people, financial planning should always be done as soon as possible, particularly, an example for this client who's a DB pension transfer, is getting more and more difficult to do DB pension transfers. So back to my email. When a portfolio loses money, which can happen and regularly does happen on average every 4 to 5 years, clients often ask about the need for changes. However, making portfolio changes at a time when equity markets have fallen so sharply is nearly always the worst possible time. It is unfortunately a retail client mentality that they need to go in and fix something and that something must be done to address the issue. Some IFAs may pander to this or make it look like they're doing something, but this is often more for show than any intrinsic portfolio reasons. Some clients in December 2022 who emailed back the annual review were asking about changes, and then January 2023 produced one of the best months on record for equity markets. We do make portfolio changes and rebalances over the course of time at Cameron James, and we'll always automatically make you aware of any portfolio adjustments we recommend. However, like most good asset managers, we are proactive in our portfolio allocation rather than reactive to short-term market movements. So the idea here with clients is the best clients in the world are the ones who sign up with you. They check their portfolio with you once a year for 5 years. Okay, now I know that sounds impossible. Very few of you are ever going to be able to do that. You are going to check your accounts more than once a year, but that is what you actually should do. You should be looking at it over the course of time. You're not investing your pension pot. This client is actually in their 40s. So how are they they can't access that money until they're 57 or more, by the time the legislation probably changes again. This is a 20-year play. So if you can't access your money and you're not going to draw it down, you one, haven't made a profit if your portfolio is up, and two, you haven't made a loss if your portfolio is down, because you can't realize that until 20 years time. Your portfolio. So your portfolio is 15.63% down. In the context of what happened in 2022, one of the worst years on record at equity markets, do you think the portfolio has performed badly? I appreciate no one likes to see losses, and in my early years in IFA, I used to worry somewhat when I saw portfolios down. However, your portfolio has actually weathered the storm pretty well, which has been helped by the uplift in the markets we saw in early 2023, as markets started correcting themselves back towards a long-term upward trend. While I cannot predict the market, she asked about Scottish Mortgage, I think Scottish Mortgage have an extremely bright future. I personally buy the fund on a regular basis whenever I have surplus capital that needs to be allocated to the market. Not that how I invest my money is much relevance to her, but just gives clients a bit of a feeling that it's not like we give them something and we buy something else personally. I intrinsically believe in all of the assets and funds which I recommend to my clients. Its track record is exceptional. When looking at its top holdings, Amazon, etc., you have to ask yourself, is there something intrinsically wrong with Amazon as a company? Have they, during 2022, suddenly lost all of their entire business model? Are they now a terrible company with no market share or no ideas? The answer to that question is almost arguably no. Amazon, like most global companies, had billions of dollars wiped off its market value simply by what happened in 2022, systemic risk. The Fed raising interest rates to curb insane levels of inflation that was triggered by COVID-19 and supply chains. All of these events are entirely beyond Amazon's control and have nothing to do with them being a good company or not. To play devil's advocate, if you had left your money in cash over the past 1 year, with 12-month running inflation at 8.8%, if you believe the UK government, the purchasing power of your money would have been eroded by 8.8%. The only proven long-term method for a portfolio to remain above inflation is the equity markets. However, there is no reward without risk, and you have to trust the markets long-term. So it's really important for clients to understand that you can't just have perfect gains. It doesn't work like that. If you want perfect gains, you can only use basic accounts from banks. If you use basic accounts from banks, you're always going to underperform inflation. Inflation is currently running at 8% in the UK, 8.8% at 12-month rolling average. Some banks are now offering 3 or 4%. That means you're throwing away 5% of your money every single year. Even if you manage to get an account for 3% and it's 8.8%, that's 5.8% purchasing power you're losing every single year. Now, obviously, a client can say, well, if the client's lost money, they've lost money and they've lost purchasing power. Correct. In a bad year, that happens. But in all the other good years, you nearly always outperform inflation by having an equity-weighted portfolio at the 75-80% level for a balanced adventurous investor. I then go on with the client to also make the point in terms of DB pension assets. So when the client did their pension transfer, from the point they did their pension transfer to where we are now, we have a number of videos on the channel talking about how CETVs have decreased. The client's DB pension transfer is probably worth around 60% of what it would have been worth when she transferred it. So if the client had remained inside their DB pension pot, which obviously she deemed wasn't in her best interest to do so, her pension pot, or her CETV, her pension pot would still be worth the same. Her CETV would now be worth 300,000 instead of the 500,000 that she transferred out. So actually, by transferring into her SIP, despite the fact that a SIP is 15% down, she's still actually far better off than if she took a new CETV now at £300,000. That would be a 40% loss instead of a 15% loss. So it's really important for clients to contextualize things and say, okay, your market timing in terms of equity markets hasn't been fantastic. Your market timing of getting outside of your DB scheme was fantastic from a CETV value perspective. So it was 500,000, now it would probably worth around 300,000. Any of my clients watching this DB pension transfers will be able to justify that, and obviously let us know in the comment section below. Guys, if this sounds interesting to you, you want to have a conversation with us, have a look in the description section below to book in for an appointment with myself, or head over to the website to leave an inquiry, and we'll be in touch soon. So I just highlight that to the client as well, and really just go on to reiterate about long-term returns. You have circa 20 years as a UK SIP pension age will almost certainly rise again from age 57 until you are able to realise any gains or loss from your pension pot, during which time there'll be numerous gains and losses each year in the market. You cannot control your first year in the markets, which are on the worst on record, but the last 20 years of equity returns is likely a better benchmark and barometer to use than the past 1 year, which will only make up around 5% of your time invested. I would be heading in the same warning, or I'd be heeding the same warning if your portfolio was up by 15.63% a year. I'd be reminding you that such returns are exceptional and not the norm. As per, your losses in 2022 are the exception and not the norm. And then in summary, I just go on to talk to the client. Ironically, the client didn't actually book in for their annual review meeting with us. Very often when clients feel disgruntled or whatever, they then won't take appointments with you. They won't actually talk to you. And it's like, when we do our annual planning review, it's not just about your pension pot. I've already said on the email, we're not going to suddenly rush in and sell your assets at a loss and crystallize those losses to buy something else necessarily. We may make changes, it's not necessarily what we always do, but there's so many other areas of your financial planning. Are you maximizing your ISAs? Are you maximizing your surplus capital? First into ISAs, and then obviously JISAs possibly for your children, GIAs for any surplus capital. Do you have a will in place? Do you have a lasting power in place? What are you doing with your mortgages in the UK right now? There's so many other areas that we actually provide pretty much free advice on at Cameron James to our clients. So clients who look just purely at what is my portfolio up or down, they're really missing a trick in terms of the value and advice they can have from a financial advisor. So portfolio market volatility and portfolio losses or pension losses, being very transparent about this here. You can have market losses, but you can also have very good years in the equity market as well. Let me know any questions in the comment section below. Look forward to hearing from you. And as always, take care of the UK pension assets.